Good morning. I think we're ready to start. So good morning, everyone. Welcome to the 54th conference promoted by I.S.E.O Institute in cooperation with Brescia University. Probably you know that I.S.E.O Institute is a non-for-profit institute that was established in 1998 with the aim of popularizing financial culture through seminars, conferences, and lessons. For 18 years now, we have a summer school as well, thanks to Franco Modigliani and Robert Solow, both Nobel laureates. Our institute is well represented in the international academic world thanks to the I.S.E.O Summer School, a prestigious school that is organized by the Institute every year in June with the participation of some of the most brilliant PhD, postgraduate, young economists coming from all over the world that will spend a week in I.S.E.O to talk about the most topical global issues together with some global Nobel laureates. In 2004, our institute has received 1,100 young economists coming from 305 countries across the globe. This is the 18th edition of our summer school. We have our students here today. There are 70 students attending the school in person and about 30 that would attend remotely. Our institute has promoted 54 conferences in Italy and in the world with the participation of 39 Nobel laureates, together with a number of other internationally renowned experts. We are also sponsored by a large number of entities that truly believe in I.S.E.O Institute's mission. As to the summer school, the formula, so to speak, is this one. We collect money from our private sponsors, and these monies are then distributed to our students in the form of scholarships. That is how we manage to have some of the most brilliant brains produced by the international academic world. So let me please thank A22, Banca Valsabina, Confindustria, Minio Bonatti, Isocontrolli, Asonex Steel, Sabaf, Meta Work, Berlucchi, SIAS, Gruppo Brescia Morati, Siemens, Fedabo, Brescia Capitale, Acciaio, Gruppi Nulli, Igilete, Villa, Cogeme, and Jeffren. These are all our sponsors, along with the Studio Rosini. This year too, thanks to the cooperation between our institute and the Brescia universities, represented by its dean here today, we are here to talk about something extremely topical. I would like also to thank a Euro Member of Parliament, Mr. Lancini. And we are here to talk about these issues with Michael Spence, Nobel laureate in economics, and Simone Manganelli, who is the head of the ECB Financial Research Department. So thank you very much. And in closing, I would like once again to remind all of you that Franco Modigliani has always been our chairman, and since the very last minutes of his life. Without his devotion, our institute would not have been established. We really hope that through the work carried out by the institute, we'll be able to propose to the Brescia community community, as well as all the local entrepreneurs and industries, a significant cultural program. Thank you very much for your attention. Let me hand it over to Professor Maurizio Tira, Dean of Brescia University, and I'd like once again to wholeheartedly thank him and his cooperators. Good morning, everyone. Thank you, Riccardo, for this further opportunity to cooperate. Riccardo Venchiaruti knows that ever since I was appointed Dean, I have always considered Istituto I.S.E.O as a spectacular, a really brilliant initiative, and we wanted this initiative to reverberate across our university. I mean, I.S.E.O is only 20 kilometers away from Brescia, and I didn't want I.S.E.O to host that many laureates in economics that would not be present at the Brescia University as well. So we joined efforts and we managed to organize seminars together, even during the pandemic. I'm very thankful to Riccardo Venchiaruti and all his collaborators for this brilliant initiative. This is an initiative that allows us to convene some of the most brilliant students in economics from across the world, to convene them here in Brescia. This is really an extremely interesting initiative that is extremely significant worldwide. My father wanted me to study economics, and of course I didn't follow his advice, and I became an environmental engineer. But this is what happens when father and sons discuss and don't agree. But I am always been very interested in economics. Today we are facing so many crises. Climate change, I mean, as clearly proven by this room, the temperature is extremely high because of climate change. And then there is another crisis that is triggered by an international conflict. The latest that broke out between Russia and Ukraine is only the latest in a long list of about 70 wars that are underway right now. It's a world that still needs technological innovation badly. International relations are tied to sustainable development of the UN have to meet a nature target. So we really have little time to reach those objectives. I'm sure that today's speeches will give a significant contribution to the international debate. Since we have a member of the Euro Parliament here with us today, I would like to say that our country will hopefully really streamline rules and regulations so that it becomes easier to invite Nobel laureates who go and speak at the I.S.E.O Institute and come over and come to Brescia and go talk across Italy, because unfortunately the Italian public university system does not allow us to attract these types of personalities. Our rules, our regulations do not allow us to attract prestigious personalities from abroad. That is why Italian universities rank very low in international rankings of quality university. We cannot tap international talents because of these old antiquated rules. Hopefully, thanks to the new Recovery and Resilience National Plan, we'll be able to get rid of those old rules. We'll be able to have highly renowned personalities coming over here to Italy and share their knowledge with us. So I'd like also to thank all the speakers that are here with us today, and I hand it over to Paolo Savona, who will introduce the morning session. Thank you, and welcome back rather, because it was 2019 when we held the last edition of I.S.E.O. Last year, we organized a session that was exclusively online. In 2019, the scenario, the environment was completely different. Currently, the environment is highly uncertain. Many people are talking about a looming recession. Others think that a recession will actually materialize further down the road, not really in the short term. So both economists and policy makers are trying to decipher the rules of this new economy in transition. In the short and medium term, the outlook has changed completely, and probably the long-term outlook as well has been impacted by the Russian-Ukraine war. Today, we have two extraordinary speakers who will share their views and their knowledge with us. It's a unique opportunity for our university and also for all the audience. We have Simone Manganelli, who is head of the ECB Financial Research Department, and Michael Spence, a Nobel laureate for economics. In 2008 and 2010, with the great financial crisis, many economists underestimated the impact of the crisis. With the 2020 pandemic, instead, many economists have overestimated the impact of the pandemic would have on supply chains. But we have all of a sudden understood that there are certain critical inputs. A missing input may just jam the supply chain. The WTO estimates on international exchanges and the impact on global growth were overestimated and they were short-lived. We soon went back to pre-pandemic production levels. Currently, we are wondering whether the Russian-Ukraine war and the radical sanctions that were slammed on Russia will trigger a crisis. In May, the Bank of America's economists said that in summary, even though there are several risks to global growth, if these risks are not synchronized, we will see kind of a prolonged period of weak growth across the world rather than a global recession. But what we're living now is the world of compound risks with great pressure on energy prices, inflation, policymakers' objectives that are dislocated and misaligned. The Fed has already engaged in monetary tightening, while the ECB is still monitoring government bonds spreads, and the Bank of Japan is still engaging in a monetary expansionary policy, though has started to counteract the pressure exerted on the yen. So we have this giant macro risk represented by the war, and also by other unclear geopolitical tensions. Simone Manganelli wrote that one of the main challenges for policymakers is correctly calibrate their intervention tools, trying to balance the medium-term benefit from containing these problems with the long-term benefit for the economy. So we will hear hear from them how possible different financial macroeconomic environments may emerge as a result of the end of the Russian-Ukrainian war. That is all as far as I'm concerned. Let me now introduce Simone Manganelli, who is the head of the ECB Financial Research. He graduated in Siena and then at the University of California. So, ladies and gentlemen, Simone Manganelli.
downside is this point, and you don't have anything about upside. So one way to address this is indeed to go beyond this point. What is growth shortfall is about. See again, particular picture of growth trade of the economy in power development. Here is the threshold that defines the realization of this country. Growth shortfall is an average of this 10 part. And in words, you can think of it as the number that actually values the technical part of the economy forward. Of course, you can do the same on the other part. This is what is called growth long. And it's again average of this upper value. And in words, comes to the question, what is the expected expansion of this model? And one nice look at this conclusion, first one can think about more complicated and more sophisticated measures of this. But one nice feature of this composition is that they sum up the expected growth. You sum growth shortfall and growth long price. You get some expected shortfall, which is the number that you can see. So it's a way to decompose this number in downside risk and upside protection. And why is this useful? Well, this is useful because it allows us to talk about risk management. The way to talk about risk management is to think about the policymaker has policy value at its disposal. This C is the policy value that the policymaker has, which is the interest rate, the capital ratio if you're a macro financial authority, the fiscal policy if you are a fiscal authority. And with this variable, it can somehow control to some extent the growth shortfall and the growth long run. But the risk management comes in from the fact that you see this coefficient lambda here, which is greater than 1, indicates that yes, you care about expected growth in general, but you really are worried to avoid very extreme downside scenarios. So you put a little bit more weight on this downside scenario. So this is one way to think about risk management when you check publications that have done the latest so bar versus QR. Sorry for these acronyms. That's pretty much unavoidable. These are the names of two models that are used in all the financial institutions. These are macroeconomic models. Actually, bar stands for Better Aggressive Model, and this is really the workhorse of macroeconomic all around the world that have been developed by VCs with problematic banks. And it's really difficult to overestimate the impact and the importance of these models. Now, one issue with this model is that it's a model for the average of the economy. It's not a model for the chains. So what they've done with a bunch of models, and you see the technical references out there, develop this quantized vector progressive models. Quantized is something that has to do with the case. And among the colleagues I read Robert Hancock with yet another model analysis and great information. So let me give you the intuition about what these models are about. This is the graphical intuition. Suppose you're interested in forecasting 2 periods ahead, T+1 and T+3. Think about this, 2021 and 2022. And suppose you're interested in the interaction in GDP for the euro area and financial cycle. Financial cycle is a major measure of trade availability. What the VAR model does here is again the forecast distribution for these variables, the one I showed at the beginning. And what the VAR does is really this red line is just the average, the mean of this forecast distribution. So what the VAR model does is give you an idea of how the average interaction between GDP and financial cycle work in what the Q-bar model does instead is to look at different parts of this distribution, right? It's not just the mean, but it's different quantiles different points of the distribution. Here, as an illustrative example, I've shown 3 possible quantiles.
You can think of this as the downside risk, think of this as 10 percentile. This is the baseline scenario, is the median. And this is the upside potential, is the 90 percentile on the right tail. And then it can go on and do the same exercise for financial cycle, and it can model the different interaction between these quantiles. So, for instance, here is an example of a bad scenario. What is a bad scenario? Is a shock, a negative shock to the GDP, followed by a negative shock to credit growth, to the financial cycle. And then you can keep going and you can find out what happens to the economy in this bad scenario. Of course, the interactions, and I'm going to show you evidence of this, between the variables in this bad scenario are different from the interaction in the other scenarios. Another possibility is to look at the base scenario. This is very similar to the right, just look at the central tendency of these variables. Or you can look at good scenarios. Or you can look at any possible combination of this. So it really gives a different level of flexibility to look at this model. All right, so let's now go to the implementation of these ideas. So you need to go to the data, you need to estimate these models, and you need to come up with results. And I'm going to give you 2 examples. And the first one is what I call taming the financial cycle. So, and the second one is application to the war in Ukraine. So let's start with the first one, taming the financial cycle. Now, here is the variables that we're going to look at. GDP for the euro area. This financial cycle, again, it's the amount of credit, loosely speaking, available in the economy, and an indicator of financial stress. So think of it as the level of market volatility in financial markets. And we estimate for the UI going back all the way to 1988 until right before the COVID crisis. So one thing of these models is that in economics we cannot perform natural experiment. We don't have the luxury to perform natural experiment as in natural science. You cannot go to the lab and you have everything controlled. You change one element and then you see how the system reacts. This, unfortunately, it doesn't exist in economics. You just have to take the events as they happen. But within the confines of the model, you can do this sort of thought experiment. And in our case, we have these three variables. And the thought experiment I'm going to show you is what happens to these three variables if you give a shock, a surprise to any of these variables. So you have three variables, you have three shocks, you have 9 possible combinations, and this is what is shown here. They're called impulse response function. The impulse is the shock, and the response is how the endogenous variables respond to the shock. Now, let me focus just on this part. This is a shock to the financial stress and how the GDP reacts. And I'm focusing on this because this has been really the main contribution in the macro-financial literature in the last 10 years. And that was done by Tobias Adrian, who is the financial counselor of the IMF. And what this graph shows, if you had standard VAR, the model that look only at the mean, all the simple response would be the same. Here you have 3 different impulse responses. This one is the impulse response for the 10th percentile of GDP, and then the continuous line is for the median, and the other dashed line is for the upper part. And what you see, if you have a shock to this volatility of financial market, if you have sudden increase in volatility in financial markets, you have a massive increase in downside risk to the economy. So in periods of great and unexpected financial market turmoil, the risk to the downside risk to the economy increase, while the upside potential, which is up here, it doesn't change too much. So this is something that is very important for policymakers because it's something that you want to manage to the extent possible. And so here's a thought experiment. That's another thing you can do in the confines of these models. You can try to change history and see what would happen if you had observed a different behavior of these variables. And the experiment is to say, suppose that there is an all-powerful macro-prudential authority who could perfectly control this financial cycle. So it could perfectly fine-tune the amount of credit available to the economy. So what will happen to GDP? That's the experiment we're doing here. And this is the result. So sorry if you don't see very well down there, but so this is the measure of financial cycle from 1990 all the way to 2018. And you see, this is the actual number. You see that we have these large fluctuations up and down, right? And usually down fluctuations are when the economy contracts and centralization, the credit contracts, and this further help contracting the economy. And in period of expansions is the opposite, and this is in the great financial crisis where you had this also sharp contraction to the economy. The thought experiment is that suppose you have this macro-prudential authority with perfectly control this, and instead of having these big swings, these big cycles, you could have a very smooth behavior of this financial cycle. So what will happen to GDP? And this is reported here. So the continuous line is the growth distribution of GDP actually observed, and the dashed line is the growth distribution of GDP under this counterfactual. I'm going to show in the next slide more details, but here you see that what happens, you cut the right tail, so you give up a bit of upside potential, but you also cut the left tail. You don't have this massive contraction that we actually observed in the financial crisis. So that's where this trade-off occurs. And here is it's more clear what's going to happen and where the trade-off is between downside and upside risk. In this column, you have the actual distribution of the GDP that we observed for the euro area. And I've plotted the different percentiles of the different points of this distribution. And you see the 1 percentile, so the left tail, the bad realization to the real economy was almost minus 7% in the great financial crisis. And the upside potential, 99%, is more than 5%. This column here is what happens under the counterfactual. So once you smooth this amount of credit in the economy, and you see the trade-off, you massively cut the left tail. You don't have any more minus 7%, you have minus 2%. But you also cut the right tail. You don't have 5.4 here, you have 5.8. And so you give up on the upside potential, but you gain a lot in the downside risk. What is the optimal trade-off? This is really something that policymakers have to decide. My hunch is that if they were able to do that, they would prefer the counterfactual column to the actual observed one. Okay, so now let me move to the other presentation, which is the other exercise, which is the stress scenario in the war in Ukraine. Now, this is something that we have prepared for the discussion of senior managers and governing council members in the current context. And since we also want to have a monetary policy perspective, we need to enlarge the model. We need to put more variables in it. And so the variables we're looking at now is inflation, of course. Central bank is interested in inflation. GDP, we're also interested in the real economy. A measure of systemic risk, think of it of the stability of the financial system. Financial stress again, short-term market volatility, think of it as this. And interest rate. Interest rate is the C variable I showed at the beginning. Is the tool that is available to the central bank. And then we estimate this model. And again, we can do this. Thought experiment, this natural, in quotation mark, experiment within the realm of the model. And I'm going to show you only the reaction to a monetary policy shock. And here I have 3 lines, four graphs. Let's look at the first 2, financial stress and systemic risk. So the thought experiment is suppose the central bank surprises the market by increasing interest rate more than they were expected. What happens here is that the financial stress increases, and again you have the 3 quantiles, and it's really the upper quantile of financial stress that increases. So you have the possibility of severe financial stress. But on the other hand, the systemic risk decreases. You see the second line, the systemic risk decreases. This line go down. And so here the trade-off is between short-term volatility, which is what we're currently seeing in the market and in equity markets and also in the government bond market. As I follow the press lately, you see there is a lot of discussion about this. But on the other hand, you gain in terms of lower systemic risk, so greater financial stability, which is a medium-term concept. So if you start the strict monetary policy, agents in the economy start to take action to keep the balance sheet under control, and this would lower the systemic risk. The other, and you see that if you have a tighter than expected contraction in monetary economy, this would bring, not surprising, inflation down, but it would also bring GDP down in the short term. So in the short term, you have this trade-off. Okay, and then the other exercise is this adverse scenario. So in the realm, again, of this model, you can think about any scenario you want. And here I'm plotting 2 scenarios. One is the baseline, where again, you have some average median evolution of the system. And the other one is this adverse scenario. By adverse scenario, we have elevated commodity price inflation and financial stress, which is not too far from what we're actually observing now with high energy prices and high financial volatility. And these are two charts. The first one is the evolution of euro area GDP. The second one is the evolution of euro area HRCP. So it's the harmonized index of price of consumer prices, which is our objective for inflation, the ECB inflation objective for inflation. Here it's from 2018-19 until 2022. It's a continuous line. It's just a single line. This is actual observation that we see, and these are forecasts. Okay, forecasts until 2025. We have cut here because otherwise we would have ruined the scale of the chart. And the blue part that you see here, see, this is the median evolution. This is the upper quartile, and this is the 90th percentile. And down here you have the lower quartile and the 10th percentile. So this is the forecast, if you want, of the euro area GDP according to this model. And in the adverse scenario, again, if you have a surge in commodity prices and financial market turmoil, that's the red part. And what you see is that, of course, things go down, go further down than they were predicted in the adverse scenario. But you see that the downside risk is disproportionately higher than in the baseline scenario. And this is consistent with the chart I showed before, where financial stress really causes an increase in downside risk to the economy. For inflation, you have this short-term trade-off in the adverse scenario, that you have an economy that is in recession, severe recession, more severe recession than otherwise, and you have this spike in inflation because of this assumption of the increase in commodity prices. And then over time, this would come back. Okay, so this is really, I hope to have given you a flavor of how we think about this concept and how we implement them. Of course, these models are just a partial representation of reality, and it's not only on the basis of these models that are taken decisions. There are many different contributions from many different perspectives. But again, for the young colleagues around here, this is really an exciting area of research. And if you're interested in these things, I would really invite you to dig deeper. So I leave you with the two concluding slides. The first one is that you should think about policy really as an exercise of risk management. It's really what policymakers are really doing each point in time is to trade off downside risk and upside potential. And this, I think, it's ubiquitous to not just central banks, but any policy institutions. And of course, this is an exercise which is fraught with difficulties. And yeah, I don't have the people who have to take these decisions. I just give them advice. The second one, it's important to further develop macroeconomic models that allow to better characterize these tail interactions, so this downside risk interaction and this upside potential. And the third point I would like you to take away is that rather than trying to predict crisis, it will really be better to think in terms of scenarios. And of course, scenarios have to be meaningful, so you really have to talk to people to see what their concerns are. You really need to follow the events to see where things are going in order to design meaningful scenarios. And the second conclusion, since the title of the conference talks about uncertainty, is to give you really an overview of the principles that guide the European Central Bank decisions under uncertainty. This is nothing new, nothing confidential. This is something that President Lagarde put in a blog post and on the ECB website. I really encourage you to go and read it because it's her way to explain the current thinking of the situation in the euro area and the ECB. And these three principles are, first, gradualism. What does it mean? It means that in periods of great uncertainty, you want to avoid sudden, abrupt moves. You want to move step by step. You want to observe the impact that your policy decisions have, and you want to understand what is going on. The second one is optionality. Optionality means that you don't commit forever about what is going to happen, but you rather reoptimize the policy path as new information arrives. Again, we're in periods of high uncertainty. We cannot really predict how the war in Ukraine is going to evolve. It's better to wait for new information to arrive, of course, prepare for all possible contingency we can think of, but then the actual decision has to be based on the action information that arrives. And the third principle is flexibility, and this is something that is also important. So, as you have read, we are in a period of exit from the ultra-loose monetary policy that we have implemented since the start of the financial crisis, so more than 10 years now. And you know that ultra-loose monetary policy consisted in incredibly large balance sheet. The ECB is a balance sheet is several trillions, and negative interest rates. And we already exited the purchase program, so we stopped buying government bonds and other corporate bonds since last month. We still reinvest, but we don't buy new bonds. And as in the last press conference, the president said, we are also going to exit this era of negative rates. There's going to be an increase in interest rates in July, and then something else expected in September. And the idea is that you want to use the interest rate to signal the stance of monetary policy. So this increase in interest rates serves to market participants to understand that we are going to implement a tighter monetary policy. How tight, again, depends on the events. And the balance sheet is going to be used to ensure a smooth transmission of monetary policy. And this has a lot to do with the current discussion about Italian government bond spreads and fragmentation. And since the central bank is an important player in this area, they can make sure that things don't get out of control. And I'll stop here. Understand that there are possibility to ask questions afterwards. I'll be happy to hear your comments on this. Thank you.
Grazie Simone. Sono convinto che
that you will receive a lot of questions from the audience, but I would like to take questions at the end of the two presentations. So after our guest speaker has delivered his speech. It doesn't take much to introduce Professor Spence. 2001, together with Joseph Stiglitz and who received the Nobel Prize. Ladies and gentlemen.
Thank you, Roberto. And thank you, Ricardo. And thank you, Maurizio, for having me. I see a lot of gray T-shirts here, so I'm going to get to talk with you this afternoon, I think, and then have a conversation with you. So my plan this morning is just to spend a little time on the turbulence that we're currently experiencing. I tried to pick off kind of the major subjects. So, and then some other more fundamental things are going on in the global economy that I think are pretty interesting, but aren't going to get us out of trouble in the next 2 to 3 years. And so we'll talk about those later on. Now, if I can figure out how to use this thing. This. I have to find the little red light. There it is. I love these things, by the way. The first time they gave one to me, I thought if I got a question I didn't like. Maybe I could use this to vaporize the questioner, but that isn't what it's for. All right. Now, which one goes up and down? Are you going to do it? Okay. So my objective this morning is simply to outline some of the dimensions of what I characterize as the current economic chaos. It sort of feels like piling on, and it more or less is true regardless of where you live in the world. So in Europe, we have a war, a big energy transition and diversification to deal with. You know, if you go to the lower income countries, you know, and ask yourself, what's the impact of very high, again, high commodity prices and food prices especially, it's pretty devastating unless you're an exporter of one of those commodities and are getting rich from it. And so on. You can go around, if you go to China, the zero COVID policy is sort of not working. People are upset. The real estate sector is in trouble, you know, et cetera. So I'm going to try to talk a little bit about that and then leave a little time at the end in case there's some questions, especially for Simone. All right. Now, you know, my expectation is that this let's call it volatility, is going to some extent to crowd out important longer term agendas, like the digital transformation, like the energy transition that we have to go through to achieve its sustainability. Not completely, but to some extent. I think we have to be realistic that we can't just sort of stick with whatever we thought we were doing before, you know, and pretend nothing happened. That's not gonna work. Now, I hope that effect is rather on the smaller side rather than the bigger side, for reasons I'll try to explain in a minute. I don't want to pretend anything I'm going to say today is complete. And there's one graph that's embarrassingly wrong, unless Sarah fixed it. But I'll tell you about that when we get here. The overview of this, if I had to describe it in one sentence, is this is in my lifetime, you know, kind of looking at economic systems. This one's characterized by certainly systemic risk, which just got talked about, but the highest level of some combination of complexity and uncertainty that I've ever seen, and a very significant fraction of that complexity and uncertainty comes from the geopolitical outcomes, right? They're not strictly economic. And I don't think anybody, you know, can forecast these things particularly well. I like the idea of scenarios, so you kind of get ready for something that might happen. I've been an advocate of that on the corporate side for many, many years, and I think it's exactly the right way to think about it. But, you know, there's no real way to forecast this, so a certain amount of humility is a good idea. All right, did I change it? No, you changed it. Okay, so let me talk about growth. The forecast you just saw, the worst one, is too high. It was made in the first quarter and it's been downgraded, you know, since then. So I would say, you know, listening to a lot of different voices and a lot of different models, that for the first time in a very, very long time, we're going to have global growth not much north of 2%. And that's really unusual because the emerging economies, while they individually get into trouble, they do not get into trouble altogether, and they have very high growth potential. For example, India has growth potential on the order of 7 to 8%. China's further along in the development process, has growth potential of something like 5%, maybe a little bit north of that. But it's all imploding, you know, at the same time, so to speak, for understandable reasons. If you go beyond that and sort of go around the world, I don't think the most likely scenario in North America is a recession yet, though the risks are rising. And then there are lots of people who disagree with that. In Europe, I think that because of the war and the effort that is going to be needed to diversify the energy sources, LNG instead of gas coming through pipelines, it's expensive stuff. And there's a lot of it to get done, and so on. I think the likelihood of a recession here is higher, not 100%, but higher. Russia is going to have a magnificent recession because of the sanctions that have been imposed. China is not going to have a recession, but it's about 80% the size of the European and American or North American economies, and it's going to slow down to low single digits, which hasn't happened in 40 years. And that is a huge impact on the global economy, not just in China, but everybody. China is the largest trading partner for nearly everybody you can think of in the global economy. So that will reverberate all over the place, that particular growth shift. Now, et cetera. You can go around the world. I'm happy to answer questions. Now, what's causing this? We had a big shock that you saw a few moments ago as a result of the pandemic. We had a very sharp recovery. It's a little different in different parts of the world. The Chinese one was first, ironically, given the current problems. And then a bunch of, more or less unanticipated negative forces started to come in. The China slowdown, I don't think we saw coming. So that's basically got three pieces. One is supply chain congestion, turbocharged by COVID. We have a zero tolerance policy for COVID. Many people, including many Chinese, think this is a mistake. On the other hand, having not imported mRNA vaccines, if they lift the COVID restrictions, they have a reasonable chance, according to the health authorities, of experiencing about 1.5 million deaths among the older Chinese, who, by the way, are not vaccinated. The part of the population that is not vaccinated in China is the older group, because they viewed it as risky and nobody told them otherwise, so they just stayed out of the system. I think the hope was they could solve this problem another way with extremely aggressive tracking and shutdowns when necessary, which is what they did at the start in 2020. But with the Omicron variants, it's not working. And now the economy's hobbled. So we feel it in added supply chain congestion, and we feel it in, but they feel it in reduced consumption. When you lock down the economy again, then you start to get effects like the ones we saw here, where whole sectors, in retail, restaurants, hospitality, et cetera, get shut down. So that's the Chinese situation. They have two additional problems. One is fairly big imbalances in the real estate sector. Now, I don't think anybody thinks this is going to tip the economy into a crisis, because they have a lot of resources. Chinese government owns way more of the assets in that economy as a fraction than any other government in the world. And so they have armament to deal with this, and they're competent, usually. The third thing they did was an extremely aggressive regulatory assault on the private sector with a focus on tech. In the course of doing that, they eliminated about $1 trillion of market capitalization in the tech, platform, leaders, and they went so far as to start to have the leadership in the financial sector that funds these companies and in the companies themselves thinking they don't really understand their role in the economy. Before, their role was to drive innovation and be an important part of the growth story, as China makes this middle to high income transition, and now they're not so sure. And it's not easy to reverse that. It sounds soft and fuzzy, but it's not. You knock the confidence out in sectors like that are very high growth, high performance, and may be critical to long-term productivity growth, not to mention whatever strategic competition you're going to have with the United States, then you've done a fair amount of damage. So that's the China story. We have shifted, most of the, this is a little bit loose, but most of the period after the great financial crisis, you could characterize as one where the main constraint on growth was demand. We had a lot of balance sheet damage. We had central banks. Basically, every time demand jumped up, supply responded. We had no sign of inflation. We lived in a world in which not only did we not have inflation, but central banks couldn't figure out a way to make inflation go up. They for sure know how to make it go down. And so I don't have any doubt about that. And we lived in that world, and almost overnight, as we came out of the pandemic, we dramatically shifted to a supply-constrained world, right? And now we have excess demand nearly everywhere, which is the proximate cause of inflation. So I think one of the things that's causing a global slowdown is just the supply side can't keep up with the demand side now for the first time in a long time, like 10 or 15 years, maybe more. And related to that, and this may sound esoteric to you, we'll talk more about it this afternoon, is that we've had, I would say, for those who kind of pay attention to global growth patterns, we have had probably at least 3 decades in which there was a very powerful deflationary force in the global economy, which was the arrival of previously unused productive capacity and people in emerging economies, entering the global economy in very large numbers. And that produced a dramatic, demonstrated, measurable decline in the cost of manufactured goods, and it also produced lots of shifting of economic activity around in the global economy. And so people in advanced economies were moving into other lines of work, and we didn't have supply constraints in those areas because we didn't need them where they were before, et cetera. You see the point. That pattern is fading, right? There are no more Chinas. China's at 10,000 plus per capita income. It may be an important manufacturing hub, but it'll be with automation and robots, not mountains and mountains of people coming from the rural sector. India isn't on a trajectory to fill that gap, though I suppose in principle it could. Africa, that's 1.2 going to 1.4 billion people. In principle, it could go down a road like that. This is a little too simple because of the digital overlay, but basically that's not going to happen. And in the meantime, in those 3 decades, we created tens and tens of millions of new middle-class consumers in the global economy. So the global economy is literally enormous. This for, Maurizio and his colleagues is the main event in climate change, is that the potential growth is nowhere near exhausted in this world. If we were trying to deal with climate change, this is a complete aside, by the way. If we were trying to deal with complete climate change and we had a pattern of declining per capita emissions, which we have in Europe and even in North America, which is an outlier in terms of poor performance historically, and we're still way too high, that'll be a manageable problem. But we got 8% growth in India. India is not even going to peak in carbon emissions until well into the decade following the one we have. China says, and I believe this will happen, but there are skeptics, that it will peak before 2030. So those are 2 major players. And the bottom line is most of the carbon emission growth is going to come from growth in the emerging economies. And the really big challenge is to make sure that we have a reduction in carbon intensity in the global economy, including our own, that's fast enough to counteract that growth. So I think sometimes people look at the stellar performance in Europe in this dimension and get too optimistic about the global situation, because the global situation doesn't look anything like what it looks like here in Europe, where we have per capita emissions of 5 to 6. 10 years ago, we had per capita emissions of 10 tons of carbon. The United States is at 15, but the tsunami is not here. It's somewhere else. We have supply chain congestion. Some of that's COVID related, but some of it's not. So for those of you who are interested in the part of economics that thinks about systems, this is an interesting thing to study. So we have global supply chains that are basically built on two things: extreme efficiency and comparative advantage. They're constructed in a highly decentralized fashion. That is, there's nobody organizing it, right? And it works beautifully as long as there aren't many shocks. And as soon as you shock that system, nobody knows what's going to do. And furthermore, because of the way it's constructed, there is no database. You could imagine in the back of your mind using algorithms, artificial intelligence, to figure out how this complex system is going to behave. But you can't do that with no data, and nobody has the data, meaning enough of it. I mean, Maersk has some of it, you know, the big shipping company. You know, some of the other people, you know, in retail supply chains, Under Armour, Nike, they've got other pieces, but nobody. So I guess what I'm saying to you, if it's just something you could think about, is we need to re-architect this thing because we live in a world of shocks, right? We have it's not just the war. We have a pandemic. We have climate shocks that are now showing up in macroeconomic statistics. We're going to have geopolitical shocks. We already do, right? Who knows what will come down the road next? But this system is built not to do well in those kinds of situations. Now, I don't know how this is going to evolve, but I'm pretty sure at some point somebody's going to wake up and say a highly decentralized system driven entirely by private sector investment decisions is not the optimal piece of architecture for global interdependence, at least in trade, and so on. And there may be analogs in finance as well. Finally, you know, let me, if I go out past 3 years, and assume we can get past most of the trouble that I just described to you, I actually think there's a potential for a very big productivity surge, and we need it. But we're not sure of that. And we just had more than 10 years of declining. The last productivity surge we had was in the late 90s and early 2000s, and we've had steadily declining productivity. So before I go on and kind of finish off, you know, depressing you, if you lived in a world in which there was aging in 75% of the global economy, and rising dependency ratios, a global economy that has, you know, steadily increased because of shocks, sovereign debt ratios, global financial crisis, upward creep, pandemic, very big increase. The global sovereign debt to GDP ratio is now over 100%. We just never been in this territory. And a rising interest rate environment as a result of inflationary pressures. And fading, you know, supply conditions in the global economy. What would you want? The answer is pretty obvious. You'd want productivity growth, right? I mean, the last one I didn't mention before is there's now, we don't know how long duration these are, but there are dramatic changes in the labor market behavior. And I don't know if any of you have flown on an airplane recently. You know, I flew to Edinburgh via London. The plane was 2 hours late and I missed the connection. I flew back. I got lucky. I was supposed to fly back through Amsterdam, which is congested beyond belief if you read the stories. And then I changed the reservation and flew back through Frankfurt. Now, I've been flying through Frankfurt for 40 years. This airport is a model of efficiency until now. So I got off the airplane from Edinburgh and I went to sort of breeze into the Schengen area to catch the flight to Milano. And the line for those of us who don't have an EU passport was, I estimated, an hour and a half long. And there were 3 people processing these folks. So I came back and asked my wife, who's an Italian journalist, I said, what's going on? I mean, this is Frankfurt, Francoforte in Italian. And she said, it's just people, they can't hire the people. And now if you go around the world, you will discover in more and more sectors, there is this condition. that they are not able to hire the people they need. They cannot meet demand surges. They can't, this is really a different world. And there's lots of interesting anecdotal evidence about this. I think it's fair to say there is not yet anyway, a comprehensive understanding of this phenomenon. But it does not look, just like the inflationary pressures, at least some of them don't look transitory. Okay, do you want me to try? This is inflation in the United States. So the last round, a number of people said it had peaked, and then it came in at 8.6, so it hadn't peaked at all. Maybe it's peaked now, I don't know. But these are levels we haven't seen for a long time. So, I think you all read the newspapers. This is first the Federal Reserve that was betting early on, and I have some sympathy with this. They were betting early on that the supply-demand problems, which are the proximate cause of this kind of inflation, were transitory and would fade, and they wouldn't have to intervene to bring the thing into balance by cutting the demand side down to the supply side of the economy. And that didn't work because the supply side problems were, or the problem with supply elasticity, I guess, to use the economist term, were more serious than really anybody understood. So the proximate cause is this. Now, I probably, should subside here and let Simone talk about it, because I am not a central banker. But my understanding of inflation is that there's two problems. One is you get either a shock that delivers inflationary for, things that are transitory, like energy and food, or you have longer term things that deliver problems with the supply side. So you could have a demand and supply imbalance, and you don't think it's going to go away, at least not very quickly. But then you have what are known as inflationary expectations. They get embedded in an economy. And what scares, as far as I can tell, what is frightening to a central bank is having inflation from demand supply imbalances persist long enough so that inflationary expectations set in. And then you start to get automatic wage and price increases, even if you remove the demand supply imbalances. Okay? That it becomes self-generating, autonomous. That was a situation in a number of economies for many years. It was a situation in the United States at the end of the 1970s. We had inflation running that had nothing to do, with what was happening in specific markets. That was when Volcker stepped in and delivered an enormous negative shock to the American economy, essentially to take the inflationary expectations out. More or less by saying, look, you go ahead and raise wages and prices, but I'm not increasing the money supply. So let's see who wins. So they went ahead and raised prices and wages, and there was a huge spike in unemployment. The interest rate went to 20%, something like that. And the inflationary expectations and a lot of other things we might have wanted to keep, like labor unions, and went out of existence. So what's the situation now? What can you expect? You can expect, at least on the American side, a pretty aggressive assault on this for two reasons. One, central bank credibility depends on not sitting on the sidelines for too long when it comes to inflation. It's not their only mandate, at least in America, but they can't just let it run. And the second one is inflation and fuel prices, by the way, are politically extremely sensitive. So you can have an economy that's doing reasonably well, but starting to experience inflation and whatnot, and the politicians don't, the feedback to the politicians is not, things are going great here, right? You can see that happening right now. So they're going to react. I think they will still try not to produce a screeching halt in the economy, and so we'll probably have a period of pretty high inflation, high but eventually declining inflation. And as I said, the hope, and it is a hope at this point, I tend to be an optimist on this front, is there are very powerful pro-productivity tools that are becoming available that we'll talk about this afternoon. The question is, how fast will they kick in? And that's an institutional and system kind of question. But if those kick in at a reasonable pace, then that will take the pressure off the supply-demand part of the inflationary equation. Again, I'm hoping it'll happen fairly fast. Some of you are probably investors, so good luck in this environment. So we are in the middle of I think the central banks knew this was coming, an extremely volatile period in the markets and a reasonably violent resetting of asset values. So I'm going to show you a graph in a minute. This is the wrong one, unless they replaced it. But we, especially for growth stocks, we're having, and especially the digital ones, a huge downward reset. Anywhere from 30% to like 70, depending on which company you're talking about. And these are big companies that dominate now many of the indices, right? So it used to be kind of cute story at the sideline. When you start getting price resets for sort of Google, Apple, Amazon, Facebook, and a number of other companies, that's not just a cute thing on the sideline anymore. It's kind of the main event in the markets. So you're getting both absolute and relative repricing. Absolute, everything's coming down, including bonds, because of the anticipated higher interest rates. And you're getting a rotation in terms of relative value toward stocks that pay dividends or some form of cash and or generate earnings in the relatively short run of the growth stocks, which are a bet on the long run, are being hurt more. And I think there's two elements to that. One is the simple discount rate argument, right? The future earnings are discounted are worth whatever they are. And if you raise the discount rate, which is I think what's happening, then you lower the value of those future earnings and you lower the multiples for that kind of stock. And the second one is they were replaced. And the reason for that is we had a dramatic acceleration in digital in the middle of the pandemic for reasons that you understand. It was kind of survival. And then I think a lot of people thought, well, this is a permanent acceleration as opposed to an acceleration that will fade, not in a mean reverting way. I mean, there'll be permanent changes as a result of accelerated digital adoption, but the pricing in the markets seem to reflect, it's, more is better, it'll go on forever. And that obviously wasn't going to happen. And so these things got overvalued. So you put those two effects together, and you get a fairly dramatic kind of repricing scenario. The other thing you're seeing in markets, if you look carefully, is that some of the companies that got funded in this period of euphoria weren't as sound as some others. We put it that way, right? So those ones were overvalued more, a little short on earnings, even looking out into the future. There are elements of this that look like the internet bubble of the kind of 2000 era. But most of the people in the room weren't here during the internet bubble, so we won't spend a lot of time on that. But basically, when you get a market that is starting to get over enthusiastic, you find you get investments that shouldn't be made. Is the bottom line. In companies that aren't worth, what the investors say. Now, on the private side, for those of you who are interested in the private, financial system is very large. Venture capital, leveraged buyouts and a huge growing growth equity segment. And that whole system is on hold right now. And the reason it's on hold is that the asset price resetting occurs very quickly in the public markets and much more slowly in the private market. So we're and the estimates are, the lag is about 6 to 9 months. So we're right in the middle, because of this lag period. It's a very awkward period for investors and for companies. The older investors and the companies don't want to have a down valuation round because they get diluted, right? But eventually the need for capital catches up with them and we're forced to go through that process. And that's when the private valuations come down. So for those of you who have big private equity, illiquid investments, probably you can expect a few negative kind of marks coming down the road towards you. I'm almost done. This is the graph that's wrong. So this is American inflation. No. Yeah, it's American inflation again. My sincere apologies. I meant to show you the magnitude of the drop in the NASDAQ in the last 3 months. It's pretty dramatic. We're back to where we were before the pandemic acceleration started. We basically killed all the incremental paper value that went with that. But I won't ask you to stare at the wrong graph or two. Thanks. So my last set of comments really has to do with another thing that I'm pretty sure is going to happen in the global economy. And that is diversification. So Europe is, I think, pretty much committed to diversifying away from Russian fossil fuels. When I looked at this, a few months ago, I asked myself, is there any example of an economy that is highly dependent on foreign sources of energy that is reasonably highly diversified in all of those sources: coal, natural gas, and oil? And the answer is yes, it's Japan. They did it on purpose. They didn't want to be dependent on it. If you go look up the data, you'll discover that Japan is highly diversified in its external dependencies in fossil fuels. And Europe is going to move in that direction. This is going to be costly and painful. It's the right thing to do. I think there's commitment not only among the leadership, but probably an understanding among citizens that you don't want to be held hostage. But if you think more deeply about this, this is really a different set of valuations. So for a long time, I think we thought about the global economy in terms of efficiency, comparative advantage, specialization, growth. These are all legitimate things. But what we're going to spend much, much more time talking about is economic security, is energy security, it's food security, etc. It won't take long to get to semiconductor security, since the leading semiconductor firm in the world is in Taiwan, Taiwan Semiconductor Manufacturing Company. And my prediction, this is not a done deal, so take it for what it's worth, is that these considerations will start to be a more important part of policy formation, and that both the private sector and even more important, the public sector will start to move us in the direction of diversifying not just energy, but all supply and demand chains. And they are responding essentially to two things: shocks from multiple sources and geopolitical tensions, broadly defined. Now, if that's right, that's a completely different architecture in the global economy than anything that we've experienced in the past. And it will behave differently. The investors will behave differently. It will have different macroeconomic characteristics and so on. I'm not saying it's the wrong thing to do, but I'm pretty sure it's the direction we're going. And if you think this is theoretical, then go and read Made in China 2025, a document that's now like 6 years old. Or you could read, the America Competes Act, which is wending its way through Congress, which is a pretty comprehensive statement of where the United States is coming out. Or one of a number of commentaries on, strategic competition between the United States and China, etc. I mean, in Europe, for example, you can find a number of initiatives that are designed to reduce Europe's dependence on kind of global supply chains in a number of areas, including semiconductors, cloud computing. And that, on balance, I think this is the right thing to do, but it's just an extremely different world than the one we're used to. I have one final comment on inflation that comes from a friend who's an entrepreneur here in Italy. He told me an interesting thing that I hadn't been expecting. He said, all of my employees are under the age of 40. They have never lived in an inflationary environment. They don't have a clue how to react to it. And so we're having a little mini internal, education program on inflation within the company. These are very talented people, and this is quite a successful company. But he said it's even worse than that. He said the IT systems that we run the company, or that every company runs on, aren't built to deal with inflation. There's no inflation variable for the inventories that we're holding and so on. So not only do we have the education program, we're rebuilding the IT systems, from which I think there's an important lesson, which is if you live long enough in a world, say without inflation, then there's a lot of people who, have habits of thought, whether they're investors or workers in companies, that are part of the behavioral side of economics that you have to understand, that they're not going to adjust very quickly in the way that, people who've been through cycles, the major institutions like central banks have seen these cycles before. The older investor crowd has seen this before, but they're not the major players anymore. So, I think this, part of my agreeing with Simone about the uncertainty that we're facing is we don't know. I don't have a really good sense of what the reaction function is going to be, because a lot of this is new to a fairly large fraction of the world who are going to actually make the decision. So why don't I stop there, and maybe you have some questions for Simone. Thank you very much.
Bene, adesso abbiamo.
We have time for a few questions from the audience.
First of all, thank you. My name is Rita, and I have a question because there was a lot of talk about growth, and I have some thoughts about growth, and I wanted to know your opinion on it. So I want to give you some examples on why I think growth might not be the best goal for us right now. So for example, I know that the profits from Shell and BP have tripled in comparison to last year's. So in that sense, this generates GDP growth, but I don't think this is value. Another concern, for example, is that if companies like Apple make phones obsolete on purpose to sell us more phones, that's also GDP growth, but it's not value. And if we have growth that is captured by, let's say, 5 to 10% of the population, well, I mean, that's great for them, but that's not a growth that I think we all care about. And then the last point is that how does this growth translate into pollution, not just in Europe, but in other countries? Because, for example, you've mentioned that we've done a great job in Europe, but the fact is that we also import a lot of goods from China, which generate pollution there. So in that sense, to what extent do our economic growth builds on pollution in other countries? So my question is, do you think that inequality concerns right now and environmental concerns are consistent with having economic growth as a goal?
Me? Okay. Go ahead. Do you want to go? You go first. Those are very good questions. And so I think there's widespread agreement now that wasn't there before, that the growth as conventionally measured, while it continues to have some import, is a totally incomplete measure of economic and social progress. As I say, a lot of people have endorsed that view, and now I think it's commonplace, at least among in our profession, but more widely in institutions. So economic and social progress is a multidimensional thing. And you mentioned a lot of those dimensions. So highly unequal growth or of total lapse in inclusive growth is problematic and shouldn't be evaluated in the same way as inclusive growth. Growth is a flow measure. Well, flow measures by definition are not balance sheets. You cannot measure sustainability without a balance sheet or something that's equivalent. You just cannot, right? So you don't know, if you have a statistic that tells you what's going to happen next year or the year after, you just don't know if you're driving toward a brick wall. In my experience in developing countries, where growth continues for good reason to be a preoccupation, but if you're building an economy on an increasingly narrow, maybe growing, but narrow relative to the size of the economy, asset foundation, tangible and intangible assets like human capital, institutions, bridges, roads and ports, et cetera, then that growth is not sustainable. And now we just have the analog of that. If you live outside the planetary boundaries for too long, it's not, it'll be an environmental catastrophe, but it'll be a complete growth catastrophe as well. So it's really a timing question. This is all by way of agreeing with you. Now, the only caveat I would add, and this is just to be a little controversial, is there's a lot of people in developed economies who think, I've had enough of this growth. And that's some reasonable position. Slow food, makes some sense. If you look at the allocation of resources in the major economies, I asked myself this question in the United States, what is the biggest single budget item that funds fundamental scientific research in the United States? And the answer is it's in the NIH, and it funds, health research in biomedical and healthcare. Is that funded to produce growth? No. It's funded to produce better outcomes in the science and eventually in terms of health, domestically and globally. And if it has a positive spillover on growth or, changes things because we get older and live longer, they don't care, right? That's not the main point. But my point in saying that is that's a huge allocation of public resources. And we do it because American citizens don't want to allocate all our resources to just growth. But if you go to a low-income country and ask what do people care about, they care about the same things we care about. They have the opportunities for their children and grandchildren, healthcare, the sustainability of the growth pattern, and a whole bunch of other things like that. The reason they pay attention to growth so much is because most of those other things aren't affordable if the per capita income's under $1,000. You just can't do it, right? So for that subset of countries, this is not a general principle, right? You can fix a lot of things by juggling the portfolio in an advanced economy, but in those economies, you have to generate the growth first. It's a necessary condition for sustainably improving the other things. And that's why one has to be a little bit understanding that, they may not be as enthusiastic about growth and other things trade-offs as we are, not because they're different, but because they're at a different stage of growth.
If I can follow up on what you just said. So first of all, you raise legitimate and very serious ethical questions. And of course, we should all reflect on that. I would say that growth is important because it is linked to employment as well. And for a country like Italy, for instance, growth is important because it's linked also to the sustainability of our debt position. And with the public expenditure, we also use to overcome some of the inequalities that we're talking about. And the issue of inequality and environmental challenges, I would say that these are the big challenges of the last 20 years. We underestimated the impact that globalization had on inequality. So globalization raised the pie, but the way the pie has been shared, it's very unequal. And this is very serious because it threatens the texture of society. And this is why it's important to deal with this, and the standard ways through redistribution, through taxation, through the state. And then it goes back to what I was saying before. Growth is also important because it's a source of revenue for the state, and the state can use these resources to redistribute or to help those who didn't get their share of the pie. And on the environmental challenges, this of course is a global market failure where no single state can address. You really need a global understanding, a global agreement. And we've seen how difficult it is, with the Trump administration before, and with China, and with all these developing countries to agree to common standards and to common understand the ways to tackle climate challenges. But there are fair questions.
Well, part of it. Let's go ahead. Good.
Hello, my name is Andrew. I have a question predominantly for Professor Spence. When you talk about diversification and the focus that governments are probably going to play on diversification in the future, I wonder what you think might happen to the potential loss of comparative advantage, and how that might affect growth. In particular, if you think there's any intricacies around, like, as a result of the loss of comparative advantage or diversification. Thank you.
Yeah, I think, I don't know who has the chainsaw, but yes, there are. I mean, I think that's a very astute observation, right? I mean, you can't expect to simply ignore comparative advantage and have it have no impact in terms of efficiency and growth, certainly in the short to medium run. But even in the long run, relative to potential. So, I mean, I guess this is a kind of short agreement with you. We're doing it because security and the psychology that goes with that, or the politics that goes with that, is important, right? So if people are, I think, the direction we're going is people are willing to sacrifice some degree of, think of it in conventional terms as, wealth, income and wealth, in order to achieve these kinds of security. But the other thing is that, this is a more complicated subject, but I mean, the geopolitical tensions, are the other thing that are pushing us in that direction. I mean, the war in Ukraine is an example of that, and increasingly tense relationships between the United States and China and others in China, frankly, including others in Asia, are examples of this. So, so that, I think, is going to lead policy in the direction of tipping the balance in. So we're already diversifying, right? We've diversifying doesn't mean pretending that there's no interdependence, but then you can tip it in one direction or another. And I think it's going to tip in the direction of domestic when you can do it at not excessively high cost, but then in the direction of what are perceived of as reliable trading partners. There's different, so Janet Yellen says friend shoring, there's a lot of different terms for this, but, and the worrying thing about that trend, and it's probably going to gain momentum, is it starts to push you in the direction of spheres of influence, right? And I can assure you that there's at least 100 countries in the world that aren't the United States, that aren't in Europe, and that are not China and Russia, who do not want to go down that road. They're non-aligned now. They're not supporting the sanctions, right? They do not want to pick sides because it's not in their long-run interests. And so there's a fairly big constituency out there, that wants to hold on to some version of a relatively open, albeit much more complicated, multilateral system that we've had in the past. And so this re-architecting, this thing to take into account the realities that people face, as well as the preferences for security and whatnot, is part of the sort of journey we're on. But gee, it's hard to know. I mean, I've written that, when people talk about the United States and China, they say strategic competition's bad and strategic cooperation's good. And I've said, well, strategic cooperation is not only good, it's essential in certain areas that Simone just mentioned. But strategic competition done the right way, that sort of sounds like Schumpeterian competition, isn't all that bad. It might accelerate, progress, including in important areas, both China and the United States and other countries. But when it turns bad is when you try to win the competition, not by investing yourself, but by tying your competitors' legs together so they can't run. Okay, by cutting off strategic supplies or financing or technology or whatever. And I think the jury's out right now. But I'm slightly pessimistic. I mean, I think the drift in the United States right now, in policy terms, is dominated by the national security, people, and agenda. And that's a zero-sum game, unlike economics. And so they don't think it's all that bad to do what they can to sort of impede progress on the other side. But then I think strategic competition starts to become damaging, because you restrict flows between each other, and then you start restricting flows through third parties, and then they don't have access to it. And this is especially important in technology. So the jury's out on this. I mean, we might have some wise leadership that takes us in a different direction, but right now I don't think that's where we're heading. But Simone, do you want to add anything to this? No? Okay.
My name is Francisco Paulo. Just have two questions. First, Professor Mike, if the road and initiative,
A little louder, please. Just
the Belt and Road
yes.
Initiative from the Chinese government,
Yep.
can be one of the solutions to this highly decentralized supply chain system. And Professor Ricardo, you showed very well. I enjoyed the graphs measuring the risk. My question is, if in the central bank, as you work in the central bank, there is also a department that can assess how to avoid the causes or the factor that's causing the shocks. Instead of not only measuring the risk, but avoiding these causes. I'm asking about the interaction between the mainstream economics and also the political economic, the political economy, if they work together in this sense, in the central bank.
Timoni, why don't you go ahead on that second question?
All right, so on the question was, what about instead of just measuring the risk, try to understand also what are the drivers of this risk? And of course, as I mentioned, this is a very simplified model of the reality. And there are many departments within the ECB. There is a financial stability department, there is a monetary policy department, monetary relation department, and they all look deeper and dig deeper behind the drivers of these indicators. So there is a lot of micro analysis, try to understand what are these deep causes. But then you need to find a way to aggregate them at a macro level, right? So you want to understand the cause, but then you also want to understand how these then interact in the macro variables. And that is the perspective of my intervention. But indeed, there is also a lot of research trying to dig deeper. And then you ask also about the political economy, and depends on what you mean. Of course, the central bank is an independent institution. It doesn't get instructions from the finance ministry of the government. But of course, especially in a situation like this, you need to have some sort of coordination, at least understanding about what is the best course of actions. And the best monetary policy decision need to be supported by consistent fiscal policy or economic policy decisions and vice versa. But then there is a clear separation of responsibilities, and the central bank is looking after price stability and financial stability.
Terrific. So the Belt and Road Initiative is a like 6 or 7 year old Chinese initiative to invest heavily in a range of countries that approximate both the overland and the marine connections between China and East Asia on the one hand, and Central Asia, ex-India, who's not participating in this, and then Eastern Europe and the eastern side of Africa. It's a very big, an important program. And I think the way to understand it is to understand that China has become by far the major investor in a wide range of developing countries, including almost all African countries. So I think and there are potential problems associated with this when that kind of investment is financed with debt. Sometimes, countries get out over their skis with a little too much debt. And even on the Chinese side, I think they're sort of learning, how to structure these arrangements in such a way that they're actually mutually beneficial. There is a theory that all the Chinese investments is in pursuit of natural resources. I think that's probably not quite accurate. A fair amount of it is in pursuit of natural resources. This is a very big economy that absorbs an awful lot of commodities of a variety of kinds, including energy. But they're investing in a wide range of sectors, as recent studies by David Dollar and at Brookings and others have shown. So that's not quite accurate. I think from a Western point of view, there is no competitor now to China. If you add the World Bank and the IMF and all the development banks together, they don't add up to the Chinese investment. And so if we're going to enter a world in which we're competing for essentially some kind of allegiance or commitments to various things, values, systems, and whatnot, we're not really on a level playing field. We're going to have to up the ante a lot in order to even show up on the playing field. And I'm not sure there's a will to do that. But I will say, I think the energy transition depends on it, right? So, and I'm not sure where the Chinese foreign investment is on the energy transition, frankly. This is a very complex subject. I mean, you can't you can't do a multi-decade energy transition by focusing entirely on green technologies, right? I mean, my friends in the general sector, the experienced people, this is former heads of, CEOs of major oil companies say, in the last 5 years, we just stopped investing, right? One of the reasons we got higher energy prices is that we were pretty close to the margin in terms of supply and demand, and then the war in Ukraine just knocked us off balance and everything kind of shot up. But the most important lesson, I think, is a kind of, and I know I'm going beyond Belt and Road here, but there's, I think, literally no chance of dealing with the energy, the sustainability challenge without, very large flows of capital across borders. There's $100 billion commitment to emerging economies that came out of one of the COPs. About 10 billion of that has been transferred. The other 90 billion is sitting in somebody's treasury somewhere. I mean, we're just not kind of getting there. So those financial flows are matter. The IFIs need to operate on the capital costs. Solar is a capital intensive, increasingly competitive technology. the cost of capital in many lower income countries where you need to deploy solar are much higher because of idiosyncratic country specific risk, right? It's the economics of solar are just different in those places, and the IFIs can change that, right? The IFC in partnership with private sectors could go in and, you know, take out some of that idiosyncratic risk because they can diversify it around a whole lot of countries. Anyway, the bottom line is, I mean, you raised a pretty important subject, but I think we're not on any kind of optimal path right now.
Thank you. My name is Raffaele Rizzardi. I'm not so young, I'm even 1 year older than you. But I want to be a witness for our young colleagues. It's a question of inflation accounting, which you mentioned at the end of your lecture. At the end of the 70s, I was a controller of the Italian companies of Nestle Group. And inflation rate in Italy was 20 to 25%. And they told us, you are lucky, in Brazil is much more. But inflation is a big problem for evaluation of a company performance. For if you are not aware, you can have inventory profits which affect your result, which is not real profit. As I said. So very small witness for our colleagues. We succeeded in the end of the 70s to make an inflation accounting with a central processing unit of our computer, which was 16 megabytes, not giga, not terabytes. So we had to stress our brain to find out how to manage this question, to isolate from the results what was inventory profit, what was inflation. And even another question was to have a monthly control of budget for if you divide it by 12 the year expended, you in the first month you say I'm saving, but after you lost. So this for in accounting standards have been made much later, right, when inflation was near to zero. So my proposal, I want to give a challenge to the universities to study the inflation accounting. For in accounting standards don't consider inflation accounting, but in your opinion, I have seen, and in my opinion, it's a big risk to over-evaluate the performance of a company, then to make false price-earning ratio. For if your earnings are over-evaluated by inflations, also the price is not correct. Thank you.
I agree with you. I think you just, so maybe you ought to come back and teach that since you did it, at least in this place. I don't think we've totally abandoned teaching inflation accounting in most of the business schools, at least not the ones I've been in, but so it's not hopeless, but there is this, you know, very pronounced tendency, which is normal, that if you have a, you know, if you have a variable that is not posing some kind of a problem for a long period of time, then attention tends to drift to something else. I mean, we see this even in economic theory, right? If there are parameters, let me take the informational structure of markets. The digital economy is just transforming that, the cost of information and so on. Well, in the old days when we built models, you know, the parameters that surrounded the cost of information, who knew what and all that, didn't move very much. So we kind of took them for granted, and the models don't have those parameters built into them. And now the digital economy comes along and we see, oh, there's something fundamental is changing here. You know, you can find anything out, you know, in a matter of, and now we have to sort of change the models, right? So I think there's a tendency in that direction, but I don't think this is, you know, look, it's a big problem if people don't respond to it for the reasons you just mentioned, but I think entrepreneurs, at least here, are going to kind of get the message. And you're right, by the way, Brazil had hyperinflation. so it was higher. And that was out of control. I mean, that was like the German hyperinflation. And they didn't get it under control until the mid-1990s. Anyway, Simone?
Yes, if I can add, that was an excellent illustration of the cost of inflation.
Right.
And this is why the consensus in the global central banking world is that central banks should, main aim should be at controlling inflation, and the target is more or less 2% everywhere. At the ECB, at the Fed is 2%. Exactly, partly for these reasons. The goal of central bankers should be to be boring, so that entrepreneurs and people can do their business without worrying about where prices are going to be. And the fact that we are in the front line and the front page of newspapers, it's a sign that there is something that is not functioning in the economy. To some extent, you can also say there were policy mistakes by policy actors. But in the case of the euro area, the goal is to have, the official goal of the ECB is to maintain price stability in the medium term. So you want inflation to be at 2%, not today, because that would be impossible to achieve, but 1.5 to 2 years down the road. And so what is key is really to understand what is driving this kind of inflation, and also to think about this trade-off I was mentioning before, because you could bring down inflation faster, but at the severe cost on the economy, as I show in one of the slides. And another element that differentiates the euro area economy with respect to the US, for instance, and that explain why the Federal Reserve already started hiking interest rate much stronger than the ECB, is that in the US, really most of the causes of inflation are driven by excess demand. It's really a demand shock. In the euro area is a bit different. There is a measure which is called core inflation, which is inflation excluding energy and food prices. And this core inflation is much lower, it's around 3%. So it's still worrisome, and that's why they are tightening monetary policy. But then there is a big supply shock component that is coming from supply chain bottlenecks, and of course by the war in Ukraine. And so it's really a challenging situation, and I really thank you for your intervention, because you explain to the broader audience why inflation is worrisome. Of course, that's not the only reason. There are many other reasons, but this is really why central bank have been given this mandate to worry about inflation, exactly so that people can worry about do their business and not where prices are going over the next year. Thank you.
Abbiamo spazio ancora per un'ultima domanda. Qui.
Yeah, I have a question for the Professor Michael Spence, and thank you for giving us the wonderful presentation. And my name is Ziwen Liu, and I'm from China, but currently I'm a first-year PhD student at the UCL, London. And my question is that you just talked about the system we designed in the presentation. I think what you imply is that a more decentralized political system might be more favorable than the currently centralized political system. And from my personal point of view, I deeply agree so, because it will unleash most people's creativity, and therefore increase the productivity and generate economic growth in the long run. But in some countries, like my country, the political system is highly centralized. So how do we persuade political leaders that a decentralized political system is actually more favorable than the centralized system? And do you think it's applicable in the developing countries like in China, because the size is so big? Yeah, that's my question. Thank you. Yeah.
Okay. In order not to keep everybody here and from lunch and whatnot, well, I'll see you this afternoon. I think I saw I.S.E.O. Yeah, on the shirt. So let me be very brief right now. So I think one of the things that's happened recently is an appreciation that for kind of healthy growth and development patterns in a wide range of countries, including advanced ones, you need some kind of partnership and complementarity between the public sector and its institutions and the private sector. So you need the private sector dynamism and incentives, especially for dynamic, what Paul Romer calls dynamic efficiency. That means really the things that change things. Ditto Philippe Aghion. But you need stable political institutions. You need a central bank that knows what it's doing. I mean, one of the very striking things that I've noted over the years is that in a very wide range of countries, a big repository of talent is in the central bank, right? Analytic talent, ability to kind of, formulate policy and test it against reasonable conceptual frameworks and evidence and so on. So those are all kind of big positives. Now, China has the biggest state. You can imagine that comes from the legacy of the revolution when they took all the assets and they haven't given them all back yet. Well, not only but the private sector has grown, and so there's a mix of public and private assets in China. And they've used this big state balance sheet pretty effectively over a lot of years. Otherwise they wouldn't have set the high water mark for 40-year growth, at a level that's unlikely to be replicated ever. And in the course of that, they made lots of mid-course corrections. They invested heavily in a way that other countries have tried to invest in people, in technology, in physical infrastructure, et cetera. So it's just a stellar performance. I think but there is a balancing act, even in China. It's a balancing act between the public and private sectors on the one hand, and I think they've got it a little out of balance recently. And then secondly, there's a balance, but on the policy side, one of the strengths of our systems, here in Europe, but also is there's lots of voices, right? There's lots of voices. Then you hear them. People responsible for making decisions evaluate those arguments and then they make choices. It's an enormous strength. And one of the concerns that I hear people say about China, including some of my Chinese friends, is that the number of voices that are going into policy decisions has declined in the last 2 years, which ultimately will affect the quality of decision making. We'll see. I mean, it's a resilient system with an enormous track record, so I'm not exactly pessimistic. And I certainly don't think China's going to get caught in the middle income trap, because that trap is normally associated with trying to live in the past, and that's not what's going on in China. But we'll talk more about that this afternoon, okay?
Bene, direi che abbiamo chiuso con
That's all as far as questions are concerned. We are coming at our closing. I would like to thank the speakers and also the audience. Today we have received a lot of information. Some answers were given, but what we were taught is that there is no magic wand, there is no one recipe. It's very important to understand how we are positioned, where we stand, and sort of where we're going. We learned something about policies and pure research. We understood that it's a rather complicated matter. But it's important to see the various variables and to design the logic underlying these policies. And by doing that, we will be able to achieve the necessary trade-off that is so important, not only in the short and medium term, but also in the long and very long term, since we're living through an age of transition, as Michael Spence and Simone Manganelli. Thank you, and see you next year.